We're joined by star investor Ron Barron. He's been a firm, longtime supporter of Tesla, which is, of course, one of the year's hottest stocks. In fact, Ron first told us about the company's potential back in 2014.
The opportunity here is not for them to do 35,000 cars on the way to 50 or 100,000. The market is for 100 million cars a year. Like maybe they could do in 8 or 10 years, they could do 1 million or 2 million cars a year, but the potential, they could do 10 million cars a year in 15 years. So the potential is enormous.
And what a ride it's been. That stock soaring more than 80% so far this year. That's right, this year. And by the way, it's only February 4th today, so you're talking about 80% gains over the last month and a few days. Tesla's market capitalization is now $140 billion. It passes names like Lockheed Martin, Union Pacific, Eli Lilly, and Costco at this point. Ron Barron is the chairman and CEO of Barron Funds, and he joins us for the hour. And Ron, it's great to see you.
Thanks for inviting me.
Let's start with the obvious, with Tesla. This is a major holding for you.
So we could do Tesla, or we could start off with a little bit about processing and get into Tesla to show you where we got it from, whatever you want to do.
Well, let's just start talking about, let's work into the processing part of this. Let's just start off talking about the ride that we have seen, let's just say, over the last month or so. What have you thought as you've watched the stock go up 80% from $400 and change to this morning looking at $836 in the pre-market?
Well, you got to remember that 2014, when we were buying our stock, about 1,000,006 shares at an average price of $219. And as you know, since I've been on the show several times since, the stock went between 350 and 180 and 250. So it's all over. And that period of time was when this company wasn't profitable, was expanding rapidly. It was being criticized by short sellers. It was very difficult for them to get started because dealers would try to prevent them from selling cars in individual states. But now things have all come together. And but in the period of time since 2014, the stock price didn't change very much through last summer. So through last summer, our $219 stock was $230, $240. So we made 10%, 20%, 30%. At the same period of time, the company's business, we focus on business, not stock prices. The company's business had grown from $2.8 billion of annual revenues to $25 billion of annual revenues, eightfold. So the company's up eightfold, stock's up 20%, 10%. Now what's happening, this is just catch up. Now this year, Tesla is going to do somewhere around $32 billion of revenues. And I guess that they're going to do $100 billion of revenues within 4 years. And I think they have potential for $1 trillion of revenues within 10 years. So basically, you're looking at the very start of what's going to happen with Tesla. This could be one of the largest companies in the whole world.
$1 trillion in revenue in 10 years?
That's assuming you do 10 million cars. There's 90 million cars or 95 million cars that are sold, yes. And that's without the battery business. So I'm thinking that we're thinking $750 billion to $1 trillion of revenues just on the car business. Elon says that the battery business is going to be as big as the car business. In addition to that, when I'm thinking about 10 million cars a year, the last conversation he had, he said it was 20 million cars is what he thinks he can do. And so what we're talking about is a business that right now, demand is overwhelming for the product that they're selling. And they're constrained as far as making as many cars as they could sell because they don't have enough batteries. So now there's a nice move, announcement today about Panasonic making money in the plant they have in Reno. But they need to have more batteries. So they're going to have a battery day in a few months. They're going to have all the analysts coming out, and they're going to show how they're addressing the issue of where are these batteries going to come from to make all these cars that are possible to make.
You're clearly still very bullish.
Yeah,
but it's moved 80%. It's moved 80% since the beginning of the year. Just in terms of discipline in maintaining a portfolio, do you lighten up on any of that position at all? Because you think, you know, I still have a large position, even if I sell a little and book some gains. Or no, you're holding the whole thing.
Not a share.
Not a single share.
No. And in fact, one of the portfolio managers was speaking to me yesterday, and he said, "Ron, shouldn't we sell a little bit?" I said, "I'm not selling anything. This is the very beginning of when Teslas get started."
Ron, so here's the question.
I'm hoping we get more assets so we can buy more
make
stock.
it the #1 car maker in the world.
Well, I think Toyota's
about 10 million now.
A little bit more, 12 or 13 million. But a lot of those companies are. I'll deal with the competition in a moment. But go ahead.
Well, no, so that was my question. I was putting Toyota in the 10 to 12 million category. Effectively, Tesla has to become the next Toyota for this the numbers to be what they are.
Yes.
And so the question is, how do you consider the competition? and why you're so convinced that they will be the next Toyota, if you will.
So the question ought to be, well, how come, if it's so easy to make a car, it's so difficult to make a car, and how could Tesla possibly be successful? And how come the other automobile companies can't just crush them? Why can't they do that? And there's two big issues that the existing automobile companies, let's say they sell 90 million cars a year, and let's say it costs $5,000 of capital spending per car in order to make 90 million cars a year. So they're invested $450 or $500 billion in their existing facilities. That's making, probably 40% of that is making motors. So basically, when you're transferring from an internal combustion engine into a battery, so here you're a Toyota, or you're General Motors, or you're Ford, and I come along and I say, hey, listen, we don't need to make those engines anymore. Let's use my battery. And you've already got these, $200 billion invested in engines. Are you going to really stop that? So that's one challenge for automobile companies. In fact, the automobile manufacturers in Germany were fined by the regulator saying, how come you're not moving faster on making electrification? The reason they're not, of course, they're going to obsolete all those investments they have. That's stranded assets. So number one, financially, it's very difficult because they have to invest as much in making electric cars as they're going to have to write off in motors. And where's that money coming from? That's one. Number two, the challenge is that the dealers distribute these cars all around the country, franchises, irrevocable. And the dealers make money not on selling metal, but on servicing the cars. So if you have all of a sudden a replacement, and that's all the distribution, and if you have all of a sudden a replacement of engine that has all the service requirements with a battery that doesn't have any, and you have the parts that are so few compared to thousands in a regular car, why should a dealer, when you call up your dealer and say, I'd like you to sell the electric cars instead of the gasoline engine cars, what are they going to do? They don't make their money that way. So they have to totally revamp the whole strategy.
Incentive system.
Yep.
Hey, Ron, I've got a question from Rick Reeder over at BlackRock. He's a Tesla owner and a huge fan. He actually sends his congratulations along, says that you saw this long before anybody else did. Now there are all these analysts who are kind of jumping on board with this. But as an investor, he said you should be congratulated for what you saw so early. But he does have a question. He says at today's valuation, it's going to take a long time for the cash flow to catch up. At what point do you think the valuation is too far ahead of the medium-term cash flow potential?
Well, at the last conference call, Elon noted that I'll get to that in just a moment. Elon noted that the demand for the Model Y is going to be greater than the Model S, X, and 3 together. So that's number one. So you have that big increment of demand coming on. Number two, Cybertruck, he said, is going to be in such demand they can't foresee how they can meet demand for 3 or 4 years. So that's another one. Then they have the big 16-wheeler truck. That's going to come on sometime. Then you have autonomous driving. That's going to come on sometime. Then you have the replacement of the peaker plants for utilities with these massive batteries. That's growing 100% a year. That's going to come on sometime. And then 10 years out, there's still a lot of growth coming because you're going to have these autonomous fleets of cars. And then in addition to that, you're going to have logistics business like Amazon has. So basically, it's not just the next 10 years that's going to be this phenomenal growth. You have years after that. And we're talking about a business that's growing 50% a year. So if I'm thinking that in 4 years, they're going to do 100 or 120 or 130 billion dollars of annual revenues, and say they make a 15% profit margin, operating profit, that doesn't mean they're reporting it because they're going to take money and spend it to grow faster. So we make a lot of money by investing in businesses that are building factories, that are launching satellites, that are building hotels, casinos. And so while they're building them, they're not making money from those investments. Tesla would be building factories, and that's when we're investing in it, when that's happening, and penalizing profitability. So how much is this worth? If you have $15 billion of profitability, so-called, in 4 years, why wouldn't that be worth $300 billion in 5 years, 4 years? And then on top of that, if you get out to, I forget the roofs, the solar roofs, that's another $40 or $50 billion business a year. And that's just starting as well. So there's all these increments, and the demand is growing so rapidly. He says that he's going to grow 50% a year, 50% a year for as long as the eye can see.
Do you care? They say that they are now building towards profitability. They've been profitable to this point. Do you care if they don't have profits from time to time? Do you care if it's not a straight profitability shot? Are you okay to stand by with that?
Well, he's got $6 billion in cash right now, and up from $5 billion in cash at the end of the prior quarter. He generated, after spending a lot of money, generated $1 billion of excess cash right now. This company also, it's the only growth company in the industry. When he bought the plant in California, in Fremont, it was bankrupted by General Motors and by Toyota, and it was a $1 billion plant. He got it for $50 million, 50. Looked at it and said, I don't know what to do with this place. What's going to go on here? And so then they spent on it originally, and they didn't know how to make cars so well, and they spent $15,000 of capital for every car they're going to make. Right. And that investment is producing a gross profit of about $10,000 a car for a $50,000 car. In China, now they know how to do it. And in China, the factory there cost $4,000 a car for capacity. That car, that they're going to sell it for less there, maybe in the 40s instead of close to 50, but they're going to make $10,000 in profit a car. So the return on investment is amazing. And then in addition to that, the suppliers are so anxious to do business with Tesla, they give them terms. You don't have to pay for what we're giving to you for 60 days. And they, from the time they take an order,
they give them those terms, or Tesla forces those terms on them?
Well,
I'm guessing they're not offering them up.
I'm guessing they're an institution. They're trying to make money. Right. But the suppliers give them 60 days. And our guy, from the time he takes an order to the time he gets paid for it, after he sells, makes the car and delivers it, is 30 days. Right. So basically, the suppliers, he's got negative working capital in this business. So Rick, what's it going to be worth? I mean, gee, I can't see how, now, of course you can see, but my idea is that in 10 years, this is going to be at least $1 trillion of revenues, and it's nowhere near ended at that point in time. There's a lot of growth opportunities from that point going forward.
The ringtone on my phone is Elon Musk saying, boring, boneheaded questions are not cool, from that conference call several quarters ago, when clearly he was under a lot of duress, et cetera. There was, let's call it those times of his troubles. How's he doing?
I think he's doing really well. And now that he's profitable and generating cash flow, and employees are happier because they're making so much money because their stock price has gone up, and he's being praised instead of torn at. So I think he's doing much better. And he also sent me a note a couple of days ago, and I was telling him about my Egyptian dancing that I was learning, and he told me and I said I wasn't sure I was going to be able to do it, but he told me he had great confidence I could do it. So I did it.
Well, let me ask you a question. Have you ever doubted in the story along the way since you've been an investor?
Well, I told him originally, and I'm sure I told everyone else as well, that I wasn't sure if it was going to be successful. I gave it a good chance. Initially, I thought it was unlikely when he came public at $30 or $35 a share. Changed my mind when I realized I was wrong and the stock had gone from 30 to 80. And I was out in California with Mike Lippert, and we were visiting one of our portfolio managers. We were visiting with Elon for a couple hours, and Mike had to cut out early. And after they said, oh, my God, Mike, at least you're smart enough to have invested in Tesla. I can't believe I didn't. And he said, Ron, I sold it. I said, you sold it? Are you kidding? After you just listened to what he said, you sold it? He said, I sold it before. And so I watched some more, and I said, I have to own this. And I started buying at 160. So here, at $30, I didn't buy. I started buying at 160, and it took me 2 years, took us 2 years to buy. And I thought that I was going to be likely successful at that point, even though 50 car companies have failed in my lifetime. I said, this one really has a chance. They sent out a car to my house to East Hampton to drive and see if I could, Anyway, that didn't work out great, but
what'd you do? You hit something?
Did you have an accident?
No, I got into the car, and it was a prototype model, and it was hard to get into it, and I stepped on it and took off so fast. I said, well, how do I know that a truck on the highway is going to see this car? I felt like I'm in a boxcar when I was a kid. And he said, oh, and they said, no, don't worry about this. And they showed me a picture of a 16-wheeler truck sitting on top of this car to show it's indestructible. And I said, that wasn't the picture to show me. And so I looked at it, and so I wasn't convinced for a long time. And then ultimately, I said, boy, I really think this is the case.
But I mean,
just one more thing.
Okay.
And the one more thing is that I said that, whether he's successful or not, I am really glad that I've invested in this company because I'm helping. This guy's saving the earth. This guy's an unbelievable guy. brilliant guy, great businessman, and saving the planet.
Okay, you can be a philanthropist, but let's talk about...
I intended to make money.
Right, and you have. You've made a lot of money on this, but there have been so many times along the way when it was probably hard to stand by. Were there times that you had doubts since you became an investor, whether it was Solar City getting wrapped in, whether it was all of the issues that got brought up along the way, or have you just been steadfast the entire time?
The 420 private equity
well, I do talk to them regularly. And I am aware, so it's not me relying on what other people are telling me is, things I should think about. Mm-hmm. We're talking with them all the time, and to trying to understand what issues are, and not just with Elon, but with other executives at the company and with the chairwoman. And so we talk regularly, and no, I was never shaken. In fact, guys in my office said they were amazed that I was just sailing right through it. I was convinced the whole time that this was going to be a very successful venture, and I told other people I thought it would be. I was convinced it would be.
Candidates now heading to New Hampshire for next week's primaries in that state. As the race for the White House kicks into high gear, investors want to know more about these candidates' tax plans. And for that, Robert Frank joins us at the table this morning.
Good morning, Andrew. Well, one of the issues at the heart of these primaries is the wealth tax, championed by Bernie Sanders and Elizabeth Warren, but opposed by Buttigieg, Biden, and lots of other candidates. A new study, though, finds that the wealth tax could lead to a massive takeover of U.S. assets by overseas investors. So Sanders' wealth tax, of course, starts at 1% for individuals with $16 million or more, rising to 8% for individuals with $5 billion or couples with $10 billion or more. He said it would raise $4.4 trillion over 10 years. Now, the Tax Foundation finds that because overseas investors would not face a wealth tax, they would have a substantial economic advantage over Americans in buying and holding U.S. assets. So if you look at stocks, bonds, private companies, real estate, even art, they would all be effectively cheaper for overseas buyers. A wealth tax, the report says, would induce foreign inflows of hundreds of billions of dollars a year. And it says that international investors would replace homegrown billionaires as owners of capital. Now, it says a U.S. investor worth $25 million, let's say they own a bond that returns 5% a year. The effective tax rate for Americans on that would be 40%. That is, of course, before any income or capital gains tax. But a foreign buyer wouldn't pay any of that. Now, the foreign inflows would drive up the value of the dollar, and that could more than double the trade deficit. Now, there are lots of problems with the wealth tax, but this is one of those unintended consequences where you just think about that economic advantage of an overseas buyer versus a U.S. buyer.
Robert, let's stay right here. We've got a lot more to talk about this. Let's bring in Ron Barron, who's been listening to this and kind of going through it yourself. Ron, what do you think?
I agree with him.
I'm with him. The unintended consequences, have you thought through?
No, I haven't thought about that before. But that's amazing. He's right. And so I agree with that. But people in general, they want they want our firm to invest money for them, not to express political opinions. I hate the wealth tax idea. You want surtaxes on people with high incomes, that's okay. But the wealth tax, I think, is an awful idea.
What's the difference between putting taxes on people who have high incomes and a wealth tax? What to you is the separation?
If you have assets and you invest in your business, and all of a sudden they take some percentage of your business away every year, how do you invest in your business any longer? And you create jobs. Where does that money come from?
So, Ron, different question for you, but related, which is under, for example, the Mayor Bloomberg's plan. You're a New Yorker.
Yep.
Still, I believe.
Yep.
I don't think you've
Nope, I'm a New Yorker.
Florida just yet.
Well, I do have a home in Florida, but I am a New Yorker. Pay taxes in New York.
Likely,
New York resident.
You would be at a what did we decide? A 56, 57?
56%.
A 56%, 57% rate.
I'm over 50 right now.
You're over 50. Are you okay at 56?
Not on capital gains, though, Ron.
On capital gains less, but they're going up on that too. Yeah, so.
But no, but it's your.
So one of the ideas behind me is, investing for the long term and holding your investments and trying to make them appreciate. But as far as if you're taking money away, how are you going to do that? So basically, you couldn't have a business like mine and invest and build out more floors and hire more people. We've never had in the history of a firm a layoff, not once. So basically, times are good, times are bad, we hire. So people never get fired because the economy is not doing well. We just take the hit in Barron Capital, and so people can plan their lives. And so how do you do that if all of a sudden your capital is being taken away from you to support your business?
That's with the wealth tax.
With the wealth tax,
right?
And with the income tax, okay, so you don't have quite as much, but you have, your assets. You can grow it, but you can't grow quite as fast if the taxes are higher.
Yeah, let's think logistically, right? So you own a business, and they say, okay, we want X% of it. So what do? Do you sell off a piece of it? I mean, how do you actually execute on the tax unless you've got cash sitting on the side? I guess I equate it to when someone dies and there's an estate tax and maybe you want to keep a physical asset like a house. Is there enough cash in the estate in order to pay off the taxes on the house, right? It's the same idea. You've got to have cash ready, or else you're selling off a part of your business.
You either have to have cash on your balance sheet, or you have to borrow, or you have to sell part of your business. That's the alternatives. So it makes it more difficult. It makes it much more difficult as a business person to grow a business. And supposedly, what we're trying to do is grow businesses. And if the businesses don't make enough money to expand, how are they going to do that? So ultimately it passes down into the people who work for a business. Where do those jobs come from?
We're watching shares of Tesla this morning. Take a look at this stock because it is surging 12% this morning. This after yesterday's wild ride, closing in on $900 this morning. And we have one of the great bulls on this stock with us this morning. Ron Barron is here. I have a question for you, by the way, before we get to any other issue. At $900, if we get there, would you split this stock?
No.
No. Because? Given the retail interest in this stock, you could make an argument to split it if it stays at these levels.
Well, you can make an argument that if it's retail, then what they should do is they should buy Barron Funds that owns Tesla, so they don't have to do it themselves.
That's a good advertisement.
I don't think that it's a great idea to split stocks. Buffett has never split his stock, except when it got really high, then he gave you that little
shares, right?
baby thing. I don't think it really pays to do that.
The B shares was more of a way of letting other investors who had been in another company he acquired go ahead and stay in and get out.
Yeah. Can we go back to the whole idea of just discipline in a portfolio? I mean, you said one of your portfolio managers asked you if you should lighten up. I mean, you understand the question, right? It's had such a huge run.
So, there was I want to get to that.
And you're not selling anything?
No.
Even though?
No, in fact, I was hoping that our business would grow so that I can have more money to invest in Tesla. How's that?
To add even more to the position?
Yes.
Are you adding to the position now?
If it was up to me, I would, but in the way we're structured, if we have real estate and we have in emerging markets and we have international and we have small cap funds, they can't buy Tesla stock. So basically, so let me go to price for a second. That let me do process for a second and then price. The idea is that what we do is we invest for the long term in growth companies that are competitively advantaged with great people. That's what we do. Growth companies, competitively advantaged, invest for the long term, great people. And so it's a very simple process, except people can't do it. So if you talk about Amazon, very few people in 1999 would have bought Amazon and held it when the stock went down, and then the stock went up dramatically. If they had held on, they could have done it. So basically, retail people, regular people without knowledge about it, of the understanding of business, how can you possibly hold on when you have a volatile stock? How could you hold on to Tesla stock when it goes up and down when you're a retail investor? This isn't retail. And retail people would come in and go out. But so my idea is that we don't invest in the market on, to go back in, on what's happening in the news, not on Asian flu, not on Spanish flu, not
right.
So not on impeachments, not on oil price, nothing like that. It's just strictly on fundamentals. And when you talk about holding for the long term, so two companies, Primerica and MSCI, both went public around 2008. And they both told me, both executives, both companies, they said, Ron, you enabled us to go public. I am forever indebted to you. Primerica said that. The stock was $20 at the time, spinning out, it's now $125. Okay. We bought stock at the originally, held on every single share. Next thing, MSCI. And this is, I'm getting to the, can I go? Or?
Yep, no, go ahead.
MSCI, Henry Fernandez, I've had him on with me in 2008. Stock was $15 a share, had him on last year. Here's an immigrant, comes from Venezuela, I don't remember which country, one of those countries, coup. They had to flee the country to stay alive, comes to America penniless. He comes up with the idea of MSCI, Morgan Stanley, brings it public. We invest in it, and $15 a share in 2008. It's now $300. And we have never, so he asked me to speak to his board last week, and he wanted to understand how is it possible that everyone was buying and selling his stock, and they had a speed bump when they did the risk management. How was it possible, Ron, that you invested this whole time and never sold a share? And he said that what he wanted to do was have me speak to his board to have them, so I said I could explain to them, how did we withstand pressure to sell? How did we do that? And I think there's another triple or quadruple coming in this one.
So what's the answer, though? I mean, we're just trying to get to the...
So he said the answer was that he thought that I believed in him.
Right.
And then in addition to that, I really liked the business. And so after I did this presentation to their board, there were 20, 25 people. Then afterwards, it turned out that the former president of Fidelity Management was sitting in this meeting. And so he walks out with me to the elevator and he says, Ron, you know, you're friends with Peter Lynch and Will Danoff. And did Will ever tell you the story about what he tells analysts that he inaugurated an initiation to Fidelity? I said, no. He said, well, first thing he does, he puts them all in a room, and then he puts a telephone with a speaker on it, and he calls his mother. His mother is in Alabama or Arkansas, wherever I think she is. And he calls her and says, Mom, what did you always, on the speaker, and all the analysts are sitting around and said, Mom, what did you always tell me when I was young? And she says, Will, I always told you that people know the price of everything, they know the value of nothing. And so basically, that's the whole idea here. That the idea is that, of course, anyone can see the price of the stock, but you can't tell me, the regular person, that this Tesla stock is going to go up 10 times or 20 times from here in the next 10 years.
Okay, I have a couple questions for you, and we're going to go fast with them. One, Elon Musk's compensation. So he's making, he captures 1% of the company for every $50 billion of the company that he moves in terms of the market share. Are you happy with that?
Well,
you find that acceptable?
Of course, I found it acceptable because I voted for it. But if you think about it, he didn't work for any salary at all for the past 3 or 4 or 5 years. And so if he makes our shareholders a lot of money, then he's entitled to a lot of money. How much is he entitled to? The board decides that, and the shareholders vote on it. And so I voted for it, so I obviously thought it was okay.
Okay. Elon Musk says on the conference call just recently that he thinks that retail investors understand this company better than institutional investors. You spent a lot of time with both. Is he right? And if so, why?
Peter Lynch would say that people, when they go into a mall, 30 or 40 years ago, when they go to a Gap store, they understand that that was an interesting investment. And I think the same thing with retail people. My grandchildren, one guy is 5, one guy is 7, and my 7-year-old a couple years ago says to me, Grandpa, that those cars, they're very bad for the environment. Tesla is good for the environment, even children. Tesla's built their whole business, no advertising. You watch on, see, a brand, everybody knows the name Tesla. Isn't that amazing? That you built a business with not a dime spent?
The stock was up 20% yesterday. It's up 12.5% this morning. That's $100 this morning in the pre-market, which maybe you're right. Maybe it's a lot of people just figuring it out. But at some point, do you worry about momentum moves?
Well, I think about it, and I think I'm responsible for other people's money. I'm the biggest shareholder in our mutual funds.
Right.
And so, on the other hand, yeah, I think about it. But I do think we're going to make 10 times from here in the next 10 years.
You said something before the commercial break, by the way, that some people on Twitter seem to pick up, which is you said, look, even if this didn't work, I was happy investing in the company because I thought that Elon Musk was doing the right thing for the world, right? Climate, all of these other issues that I know you support.
Yep.
There are some people who would look at that statement and say, but you're a fiduciary for my money. You shouldn't be investing based on whether you think this is good for the world or good for the future. Look, I always say investing in Elon Musk is like, or betting against him is like betting against humanity. You want the guy to succeed. I get that. But the question is, when you thought about this investment, I assume, or I hope you did this strictly on the financials.
I did it on the financials. I felt I had no downside. And no downside, right, even if they weren't very successful, is that they were going to be the leader in this business, and they could be acquired. I felt there was no downside. Right. Okay, let me ask you. I thought the worst case, we would double our money.
Okay, let me ask you a separate question. Given how bullish you are on the company, given that Elon Musk tried to take this company private at $420, some people at that time thought that was crazy. Do you think that he was trying to rob the shareholders?
I think he was really discouraged. If you work the hours that he works and are under the stress that he was under, and he was being attacked relentlessly by embedded interests who wanted him to fail. And so if you're in business and all of a sudden the oil companies will be impacted negatively by what you do, and the car dealers are negatively impacted by what you do, and the OEMs are negatively, and the short sellers are negative. So all those guys are up against him, and this guy is standing alone. Wouldn't you be upset about the way people are treating you? If you're doing something that you think is great for the world and everyone attacks you every day, why would you think that's that's acceptable? And so in fact, I thought this was a really bad idea. I thought he would be better off if he remained a public company. But if he went private, I was interested in participating as a investor to allow other investors to be able to continue to hold their investment position in Tesla. And I was being considered as an entity. But I recommended against doing that, but that would have been beneficial if I was chosen to be the person who had the ability for individuals to continue to invest even though it's a private company.
Let's get right back to our guest host this hour, Ron Barron, who is a legendary buy and hold investor. He's been talking with us this morning about Tesla a lot. But, Ron, I want to run through some of your other stocks, too. We just showed shares of Hyatt as we were heading to a break. That's a stock you bought into when?
2008, 2009. And I had been an investor when I started my career in the 1970s. And Jay Pritzker, Tom's dad, who's the president chairman of the company, he was one of the first people to help me in business to sort of, get me started. So I have this very good feeling. And then he brought the company private. And then I'm friendly with Tom since 1979. 1979. I looked at the prospectus when they're going public, and it was $60 a share, $61. I'm sorry. It was amazing. He was 61 years old. And so what happened here is that Jay dies and his brother died in 1999, and the family is now feuding. There are 17 people who are on the Forbes 400 who are from Pritzker. 17 people out of the 400. And then, so he dies, and then the family begins to feud and to figure out how they're going to manage money instead of having Tommy manage money for them. They want the money. So Goldman Sachs partners up with the Walton family. Mm-hmm. And
let's look at a longer-term chart in the guys in the back, guys. This is a one-year chart, but let's look longer term because Ron's been an investor since 2009. And
so Goldman Sachs and Walton go ahead and they say to the investors, the other shareholders of the Pritzker family, we'll buy your stock. And it was $56 a share at the time. And they say, we'll pay 56 or 55, something like that. And it was private. They buy stock from them, and then with the intention, of course, going public at some point in time. And now the market crashes, and now it's 2008 or 2009. And now Goldman Sachs and Walton are sitting there with $55 stock, and more Pritzkers want to sell. They go public at $26 a share, half of the price that Goldman paid. And so they go public, and I invest in them. We buy as much as we can, and we're one of the largest shareholders in the company. $25, $30 a share. Stock's now trading at 85 or 90, and it's a confusing investment for most people. So as a result of that, we sort of have it to ourselves. And so we keep buying. The company was 175 million shares when they went public. Mm-hmm. They're now 105 million shares. The company's bought back 70 million shares, and they continue to buy back stock. They think the real estate's worth 120, 130. The stock's at 80. And basically, they're shrinking the capitalization. Tom Pritzker's holdings are now 20% and going up. And he's a guy, I love this guy. He's just the nicest, shake his hand, that's what he's going to do. And it's confusing to people because what they're doing is they're going to be capital light. So they own all these properties, and they're selling off a hotel, and they're selling it to investors, and then they're taking back a management fee. So they're taking a hotel, let's say, costs $100,000 a room, and they might generate $10,000 a year in income, and they're selling off that room, getting $100,000 for it, and then they're taking back a management fee and they're making $5,000, but they got $100,000 in their hands. They don't have to have that invested anymore and maintain it. So all of a sudden, they go to this management fee, which is worth a higher multiple. And because you go from $10, $100 in revenues to $4 in revenues or $5, it's confusing to people, so they don't see the growth. I saw the growth.
Let's run through very quickly a couple other stocks. We've only got a couple minutes left in the hour. Google shares. Two of the Barron funds own Google shares as well. We did hear from the company last night, and this morning that stock's down about 3.5%. What's your take?
I haven't studied it. We own 480 stocks in our firm, and the top 40 stocks represent 54% assets. I don't own Google. It sounds like a great company. I love the commercial on the Super Bowl. It was one of the really touching, nice, heartwarming.
It made me cry.
Yes.
Yeah.
Penn National Gaming. That's a stock that you bought into in 2002. And as we've seen gaming stocks kind of rise and as sports gambling has come in, that's been something that's taken a pretty active move too.
Peter Carlino took over a family casino, a family racetrack that was for $25 million, brought it public. After 3 Mile Island blew up in the 1980s, we invested with him off and on since then, as recently as continued. But a $25 million investment, he ultimately sold the business for $7.5 billion. Then the deal for $25 million. Peter Carlino, I would follow him anywhere. And so then the deal didn't go through because the market crashed, and then it went down to $3 or $4 billion. We invested in the company then. It's now a number of different enterprises have come from that. They also have bought other casinos in which we've invested. And now what's going to happen is that they're going to benefit from the acquisition of a business called Barstool. That they've just bought for. Do you know about this?
I do know.
Yeah,
I never heard of this before. Everybody in my office knows Barstool. I didn't know what it was. And so they came in, they gave us a teach-in a couple of days ago. And this, not only are they going to make a lot of money on this investment for this $150 million and buy the rest of it out from the founder, but also it's going to increase the traffic in the casinos. It's going to be worth a ton. And this is another guy who's really a great guy.
Well, Ron, we really appreciate your time this morning. It's been a pleasure having you here.
Thank you.
And we hope to see you again soon.
Thank you very much.